Welcome back to AI Capital Brief. Today, we're breaking down one of the most powerful option strategies you can use during earnings season, a setup that literally prints money when used correctly. Earnings announce volatility, and options traders know how to capitalize on that volatility. We're using real examples from the third quarter and fourth quarter of 2025, so this isn't theory. This is what happened in the markets this year. Let's get into it. Earnings season is one of the most predictable catalysts in markets because companies report quarterly results on a scheduled basis. Traders use this predictability to position ahead of earnings, betting that the stock's implied volatility will expand and actual price moves will be larger than expected. The key here is that implied volatility often spikes into earnings, inflating options premiums, and then contracts hard after the release, creating opportunities for savvy traders to capture price movement or volatility shifts. The common tools include straddles, strangles, spreads, and gamma scalping, and I'll show you each one with examples from 2025. First up, straddles. That's when you buy both a call and a put at the same strike price and same expiration. You don't care about direction, you care about movement. Example from October 2025. Amazon. Options traders were pricing in an expected post-earnings move of about plus or minus 7%, the largest since mid-2024. Here's how a straddle works in that situation. Suppose AMZN is trading at $150. A trader buys the $150 call and the $150 put expiring shortly after earnings. If Amazon jumps to $160 or drops to $140, that stock swing can make the straddle profitable even if you're direction agnostic. For straddles to work, the earnings reaction has to exceed the combined cost of both options. In this Q4 example, implied move expectations were elevated, perfect territory for a straddle. Next up, debit spreads. Unlike straddles, debit spreads help you reduce cost and risk while still capturing directional earnings moves. Here's a real example from Q3 2025 with Broadcom. Leading into Broadcom's Q4 earnings release, analysts were bullish on growth, and the options market priced in a solid earnings reaction. A common structure was the bull call debit spread. Buy a slightly in-the-money call. Sell a higher strike call for the same expiration. This lowers your upfront cost compared with buying just a call. If Broadcom's price moved above your higher strike after earnings, you captured the upside for a capped and defined risk. This type of setup works well when your price thesis is bullish and you expect volatility to remain elevated into the release. Now let's talk about post-earnings plays, where the edge isn't direction but volatility shifting, a strategy favorites among professional traders. Example from Planet Labs' third quarter report, they beat expectations, raised guidance, and the stock jumped after earnings. Many earnings traders wait until after the announcement, when the implied volatility collapses. That's called IV crush, and if you know how to play it, it can be profitable. Here's how. In the session after earnings, implied volatility dropped. Traders will often buy calls or call spreads after earnings when IV is lower than before the release. If the stock continues its trend after earnings, those options appreciate quickly because you're catching the directional move without the huge IV premium. That means less cost, lower risk, and a chance to ride the actual trend rather than the uncertainty. Now, before you think this sounds easy, remember this. Earnings trading is binary. Stocks can move big one way or the other, and options pricing reflects that. That's why professionals emphasize position sizing and risk limits. Many allocate no more than 1 to 2% of their total capital per earnings play during the high volatility window. Examples of tools pros use: protective collars to hedge positions, calendar spreads for time decay advantage, strangles when direction is uncertain, vertical spreads for defined risk and reward. The goal isn't necessarily to hit a home run every time, it's to stack probabilities in your favor while controlling risk. Let's recap with real outcomes from 2025 earnings. Amazon, large-priced move made straddles profitable. Broadcom, bull call debit spreads worked well into strong results. Planet Labs, post-earnings volatility drop created cheap entry points. These examples show how seasoned traders approach earnings with flexible strategies, not just straight calls or puts. So if you want to trade earnings like a pro, Learn these setups, understand the risk, and never overallocate. If you found this helpful, hit like and subscribe, and comment Earnings Playbook for a step-by-step checklist you can use next earnings cycle. Thank you for joining us on AI Capital Brief. If you enjoyed this breakdown, hit like, subscribe, and stay tuned. We're just getting started. I'll see you in the next video.